A circular economy is a crucial way to help reduce waste, cut emissions, and lower dependence on scarce raw materials, which makes economies more resilient and sustainable. Financing is crucial for the circular economy to encourage sustainable corporate practices and foster a greener and more resource-efficient world economy. The Ellen MacArthur Foundation even sees the circular economy as a multi-trillion-dollar economic opportunity. But shifting to a circular economy is not free. For example, to reduce annual mismanaged plastic volumes in the whole world by 90% compared to 2019, more than $1 trillion per year is needed between 2025 and 2040. The Circularity Gap Report Finance shows that between 2018 and 2023, only $28 billion per year were invested into circular businesses in the entire world. This is only about 2% of all tracked global investments. This is far short of the trillions needed. The need is high, so why are banks still hesitant? You can view this from two perspectives. First, from the business model perspective, short-term risks are higher because circular business models require high upfront investment and more ongoing costs. In fact, more than 65% of businesses in a global survey of 420 executives state that precisely these two financial concerns are major challenges when changing from linear to circular business practices. A prime example of how this affects their ability to get funding can be observed when looking at the product-as-a-service business model, which many circular businesses use, like swap fiats. They struggle with low inventory valuation because of the second-hand nature. They can often actually only mortgage 25% of their inventory value because of this. There is also a lack of benchmark data, so banks do not know what they can expect. The payback periods for loans are often too short for this specific business model. Assets are depreciated too quickly, even if they have a high residual value, due to repairs and reuse. Banks look at this and see little to sell off in case the company cannot repay their loan, and also see uncertain cash flows, which is exactly what the current risk models dislike. Secondly, from the bank's perspective, traditional risk models are built for linear business models. Banks overlook the linear risks. A linear risk can be classified as the exposure to the effects of linear business practices, utilize scarce and non-renewable resources, prioritize sales of new products, fail to collaborate, and fail to innovate or adapt, which will negatively impact an organization's ability to continue as a going concern. So circular businesses are at a disadvantage. The current models are overlooking linear risks while overestimating circular risks. According to the UN Environmental Program Finance Initiative, most banks are most probably in the early stages of the journey towards financing the transition towards a resource-efficient and circular economy. But there are mission-driven banks like Triodos that are busier with sustainability and circularity. So, how does Triodos approach circular financing? Triodos only finances businesses that have a positive social and environmental impact. They have strict minimum requirements which exclude sectors they find unethical or harmful to people and nature. When assessing these businesses, they still also carefully look at the traditional factors such as cash flow, security for the loan, integrity of the business, and more. Triodos is also in the Dutch Circular Economy Working Group, which developed the Circular Risk Scorecard, which Triodos currently uses in pilots to assess circular businesses. So, what is this Circular Risk Scorecard, and how can it help? The CRS was developed by the Dutch Circular Economy Working Group, which is a coalition of Dutch banks working under the sustainable finance platform of the DNB. In this coalition are, among others, Triodos, Rabobank, ABN AMRO, ING, SN, and more. The CRS is specifically designed to assess circular businesses through a circular lens. The CRS works as follows. Instead of replacing traditional risk models, it functions as an add-on. It consists of 18 questions grouped into 6 risk drivers. After the questions are answered, it calculates a circular risk score from 0 to 100, where a lower score means lower circular risk. The 6 risk drivers are ability of the management team, suitability of product for circularity, security of resources, circularity of asset, robustness of contract, and finally market competitiveness. 2 out of the 6 drivers are the most important as they together make up more than half of the circular risk score. These are ability of the management team, and the circularity of the product. CRS has a good chance of success because building a new risk model, where circularity is included, would take 5 to 7 years' worth of default data, which is not available at this moment. A first analysis with the CRS of more than 100 businesses shows that circular businesses have a circular risk score between 38 and 41, whereas linear businesses have a score of 55. Meaning circular businesses score 14 to 17 points better than linear ones. There is one exception, the circular support business model. This is because these businesses mainly focus on software, so the 6 risk drivers do not fully match, making it score higher. It also shows that circular businesses manage resource risk better, design products that are more durable, and have stronger long-term contracts. Finally, every assessment of a business contributes to an anonymized database, so in the long run, circularity can hopefully be embedded into all risk models. The Circular Risk Working Group hopes to achieve this by 2030. The Circular Risk Scorecard is, of course, not a magical solution that will fix all the problems with financing circular businesses. It also depends on whether banks actually let the tool influence their decisions. But compared to a few years ago when there were no shared tools and no shared data, the CRS is a good step towards a financial system that sees circular businesses not as a far-fetched risk, but as a serious answer to mitigate linear risks.